February 6th, 2025. Shanghai freezes a silver trader whose position was larger than the exchange's entire warehouse stock. The official story? Just volatility. But here's what they're not telling you. While you were watching headlines about recession fears, someone was building the largest concentrated short position in modern silver market history. And 3 days ago, they got stopped. Not by the market, by regulators. The question business leaders should be asking isn't why it happened. It's who benefits when it happens again. Because the next move has already begun. Welcome to Currency Archive. If you've built something in your lifetime, if you understand that real wealth isn't created by following the crowd, then you're in the right place. This channel exists for those who prefer intelligence over entertainment. We don't do hype. We do institutional level analysis. If that resonates with you, if you value having information before it becomes common knowledge, then subscribe. Not because we need the numbers, but because serious people deserve serious economic intelligence. And one more thing, comment below and tell us, where in the world are you watching from? London, Dubai, New York, Mumbai? We want to know where the informed minds gather. Now, let's get into what's really happening in the silver market. On the morning of February the 6th, 2025, something unusual happened in Shanghai. The Shanghai Futures Exchange, one of the world's largest commodity trading platforms, took an action that seasoned traders rarely witness. They froze a single counterparty, not because of a technical glitch, not because of a minor rule violation, but because one trader had built a short position in silver so massive, it exceeded the entire reported warehouse inventory of the exchange itself. Let that sink in for a moment. One entity had bet against silver to a degree that was larger than all the physical metal the exchange claimed to have available for delivery. The regulators looked at this position and they said, stop, immediately. But here's where the story gets interesting for anyone paying attention to global commodity markets. This didn't happen in isolation. It happened during a week when global markets were already experiencing what analysts were calling the worst coordinated sell-off since 2008. Stock markets were dropping, bond yields were spiking, currency volatility was accelerating, and right in the middle of this chaos, the Shanghai silver freeze occurred. The official explanation from exchange authorities was predictable: excessive volatility, risk management protocols, protecting market integrity, standard language that sounds reassuring but explains nothing. Because if someone understands how commodity exchanges actually function, they know that position limits exist precisely to prevent this kind of situation from developing in the first place. So the real question becomes, how did one trader accumulate a position this large without triggering automatic safeguards earlier? And more importantly, why now? Business leaders who understand market structure recognize that exchanges don't freeze positions casually. These institutions exist to facilitate trading. Stopping trading, especially for a single counterparty, creates legal complications, reputational damage, and operational headaches. They only do it when the alternative is worse, much worse. Now, to understand why this matters beyond Shanghai, one needs to look at what's been happening in the broader silver market over the past 18 months. China controls approximately 70% of global silver refining capacity. In late 2024, Beijing implemented export restrictions on certain refined metals, including silver. These weren't complete bans. They were administrative controls, licensing requirements, the kind of bureaucratic mechanisms that slow down supply chains without making dramatic headlines. And while Western media largely ignored these developments, physical silver buyers in Dubai, Singapore, and Hong Kong noticed something peculiar. Premiums started rising. Not slightly, dramatically. By early February 2025, physical silver in certain Middle Eastern markets was trading at $127 per ounce. Meanwhile, the COMEX futures price in New York, the price that most people see quoted in financial news, was sitting around $73 per ounce, a $54 difference for the same metal. This kind of divergence doesn't happen in functioning markets. When you can buy something in New York for $73 and immediately sell it in Dubai for $127, arbitrage traders should flood in and eliminate that gap within hours. But they weren't, which means something was broken in the delivery mechanism. Either people couldn't get physical metal out of COMEX warehouses, or they couldn't get it shipped from west to east, or both. And this is where the Shanghai freeze stops being a curious news item and becomes a strategic signal. Because what happened in Shanghai wasn't an isolated incident of one reckless trader. It was a visible crack in a much larger structure. The global silver market operates on two parallel tracks. There's the physical market, where actual metal changes hands, where manufacturers buy silver for solar panels and electronics, where investors take delivery of coins and bars. And then there's the paper market, where futures contracts, options, and derivatives trade, where prices are set, where most of the world's silver trading actually occurs. In theory, these two markets should stay connected. paper prices should roughly match physical prices, because if they diverge too much, arbitrage brings them back together. But in practice, especially in precious metals, the paper market has grown so large compared to the physical market that it's begun to function almost independently. Current estimates suggest that for every ounce of physical silver that actually exists and is available for delivery, there are somewhere between 100 to 250 paper claims on that same ounce. This works fine, as long as everyone doesn't ask for physical delivery at the same time. It's the same principle that banks operate on. They don't keep enough cash in the vault to cover every depositor simultaneously, because in normal times, most people don't withdraw everything at once. But when trust breaks down, when people start demanding physical settlement, the system reveals its true fragility, and that's exactly what the Shanghai freeze suggested might be beginning. Someone had built a massive short position, betting that silver prices would fall, but the exchange looked at that position against available physical inventory and realized that if this trader was forced to deliver actual metal, there wasn't enough to cover it, so they stopped the game mid-play. For business leaders trying to understand what comes next, the Shanghai incident isn't the story, it's the warning shot. Because if one exchange in one city had to freeze trading due to physical delivery concerns, what happens when that same pressure appears simultaneously across multiple exchanges in multiple countries? In a market that's already showing $54 per ounce premiums between paper and physical? That's not a hypothetical question anymore. That's the question decision makers should be asking right now. Most people believe they understand how commodity markets work. They don't. What they understand is the simplified version, the one taught in economics textbooks, the one that makes perfect sense on paper. In that version, someone who wants to buy silver goes to a market, finds someone selling silver, and they make an exchange. Simple, clean, logical. But the actual architecture of modern precious metals markets, the way silver actually trades in the global financial system, bears almost no resemblance to that textbook model. And understanding this gap, this difference between what people think is happening and what's actually happening, is essential for anyone trying to make sense of why a single freeze in Shanghai could matter to businesses operating thousands of miles away. Let's start with a basic question. When someone buys silver through a major exchange or a popular investment product, well, what are they actually buying? In most cases, they're not buying silver at all. They're buying a promise, a contract. A derivative instrument that represents silver, that tracks the price of silver, that gives them exposure to silver price movements, but isn't actually silver. This isn't a conspiracy theory. It's stated clearly in the legal documentation of these products, buried in footnotes and disclosures that almost nobody reads. Take the typical silver ETF, exchange-traded fund, that millions of investors hold in their retirement accounts. These funds claim to hold physical silver backing each share. But when analysts examine the custodial arrangements, the audit procedures, the actual warehouse documentation, they discover something interesting. Much of the silver held by these funds is categorized as unallocated. What does unallocated mean? It means the fund has a general claim on a pool of silver, but not to specific bars with specific serial numbers. It's like having a claim check for a coat, but the coat room has issued more claim checks than they have coats. As long as not everyone shows up at the same time asking for their coat, the system functions. But if too many people arrive simultaneously demanding their specific coat, the fraud becomes visible. Now let's examine the futures market, and where most silver price discovery actually happens. The COMEX, the primary silver futures exchange in New York, operates on a system where traders can buy and sell contracts representing 5,000 ounces of silver each. In theory, these contracts can be settled in two ways: physical delivery, where actual silver bars change hands, or cash settlement, where the parties simply exchange the difference in price. Here's the critical detail that most people miss. Approximately 98% of all COMEX silver futures contracts are settled in cash, not physical delivery, which means 98% of the silver trading happening on the world's largest silver exchange involves no actual silver changing hands. It's purely financial speculation on price movements. And because cash settlement is the norm, the exchange doesn't need to have physical silver backing every contract. They only need enough silver to cover the small percentage of contracts that actually go to delivery. Under normal circumstances, this works. But these aren't normal circumstances. During January 2025, COMEX quietly increased margin requirements for silver futures contracts. Margin requirements are essentially the deposit traders must put up to hold a position. When exchanges raise margin requirements, it's usually a signal that they're concerned about volatility or about their ability to manage risk. It forces traders to put up more money, which reduces leverage in the system. Why would COMEX raise margin requirements for silver, specifically in January 2025? The official explanation was routine risk management, but traders who've watched precious metals markets for decades noticed something else. COMEX warehouse inventories, the actual physical silver sitting in exchange-approved vaults, had been declining steadily for 18 months. Not gradually, rapidly. In the precious metals world, warehouse inventory is divided into two categories: registered inventory, which is available for delivery against futures contracts, and eligible inventory, which is stored in the warehouse but not currently available for delivery. Between mid-2023 and early 2025, registered silver inventory at COMEX dropped by approximately 60%. Meanwhile, the number of futures contracts being traded actually increased. More paper claims, less physical metal. This is the mathematical foundation of the problem, and it's not unique to COMEX. The London Bullion Market Association, the LBMA, operates a similar structure. Most silver traded through London never physically moves. It's transferred electronically between accounts, on ledgers, as digital entries. The actual metal sits in vaults, often for years, while ownership claims get traded back and forth dozens of times. This system relies entirely on trust. Trust that the custodian banks actually have the metal they claim to hold. Trust that the audit procedures are rigorous and honest. Trust that in a crisis, when multiple parties demand physical settlement simultaneously, there will be enough metal to go around. But what happens when that trust begins to crack? What happens when buyers in Dubai are paying $54 more per ounce than the COMEX futures price because they don't trust paper claims anymore? What happens when a trader in Shanghai builds a short position so large that regulators realize physical delivery would be impossible? These aren't theoretical questions. These are the conditions that existed in February 2025. And here's what business leaders need to understand about derivative markets in general. They're incredibly efficient, right up until the moment they're not. They allow massive amounts of capital to flow, prices to be discovered, risk to be transferred, all with minimal actual physical movement of the underlying commodity. But that efficiency comes with a hidden cost: fragility. Because the entire system is built on the assumption that most participants will accept cash settlement, that most claims will never be exercised, that physical delivery will remain the exception rather than the rule. When that assumption breaks, when enough participants simultaneously demand physical settlement, the architecture doesn't just become inefficient, it collapses. In the current silver market, with its $54 premiums in physical markets, its declining COMEX inventories, its Shanghai trading freezes, is showing every symptom of an architecture under stress. The paper market created phantom supply for years. Now, the phantom supply is meeting physical reality, and business leaders positioned in supply chains dependent on silver, or holding wealth in silver-based instruments, need to understand one fundamental truth. When paper promises exceed physical capacity by ratios of 100 to 1 or higher, someone, eventually, doesn't get their metal. The only question is who. There's a concept in engineering called cascading failure. It's what happens when multiple stress points in a system, each manageable on its own, converge at the same moment. A bridge can handle wind, it can handle traffic, it can handle temperature fluctuations. But when maximum wind hits during peak traffic, while thermal expansion weakens key joints, the bridge doesn't just bend, it fails catastrophically. The silver market in early 2025 isn't facing one problem, it's facing four simultaneously. And what makes this situation different from previous precious metals squeezes is that each pressure point is amplifying the others, creating conditions that haven't existed in commodity markets since the 1970s. Let's examine each vector carefully. Pressure, point 1, the supply disruption. Nobody's talking about on December 12th, 2024. China's Ministry of Commerce issued Administrative Measure 47, bureaucratic language, 14 pages, mostly ignored by Western financial media. But commodity traders in Hong Kong understood immediately what it meant. China had just implemented licensing requirements for refined silver exports, not a ban, something more subtle. Every company wanting to export refined silver from China now needed government approval. Documentation, proof of end use, processing times, unspecified. Approval criteria, discretionary. This is how modern governments control strategic commodities without creating international incidents. They don't announce bans, they create friction. And when you control 70% of global refining capacity, friction becomes control. Within 6 weeks, silver shipments from Chinese refineries to international buyers slowed by approximately 40%. Not stopped, slowed. Enough to create tightness, but not enough to trigger emergency responses. But here's what makes this particularly dangerous for Western businesses. Silver isn't just refined in China. Much of the world's newly mined silver, from Mexico, Peru, Australia, gets shipped to China for refining before returning to global markets. Because Chinese refineries are the most cost-efficient, they have the scale, the technology, the infrastructure. So when China implements export controls, they're not just controlling Chinese silver. They're controlling the refining bottleneck for global supply. And there's a second supply problem converging at exactly the same time. Mexico, the world's largest silver-producing nation. In January 2025, Mexico's newly elected government began discussing nationalization of strategic mineral resources. Not immediate expropriation, discussion, consultation, policy review. But major mining companies understand what policy review means. It means uncertainty. And uncertainty means delayed investment, deferred expansion, reduced exploration budgets. Silver mining companies were already operating on thin margins at $70 per ounce. Most primary silver mines that exist specifically to extract silver rather than getting it as a byproduct of copper or gold mining, need prices above $85 per ounce to justify new development. At current COMEX prices, new silver mine development has essentially stopped. No new projects, no expansion of existing operations, just maintenance of current production. Which means global mine supply, already declining by approximately 2% annually, is about to decline faster, and you can't turn mine production back on quickly. From discovery to production, a new silver mine takes 7 to 12 years. Pressure point 2. Industrial demand acceleration that can't be postponed. While supply tightens, demand is doing the opposite, accelerating. Not from investors, from industries that have no choice but to consume silver. Solar panel manufacturing is the obvious example. Each photovoltaic panel requires approximately 20 grams of silver. Sounds small until you scale it. This isn't speculative demand that disappears when prices rise. This is industrial consumption locked into manufacturing processes. You can't build a solar panel without silver. The electrical conductivity requirements don't have substitutes at current technology levels. Then there's the electric vehicle sector. Each EV contains approximately 25 to 50 grams of silver in various electrical components. Charging infrastructure, another 1 to 3 kilograms per station. Global EV production in 2024, 14 million units. Projected 2026 production, 23 million units. That's not a gradual increase. That's a demand surge hitting a supply-constrained market. But the pressure point that concerns strategic analysts most isn't commercial, it's military. Defense applications for silver have expanded dramatically. Advanced radar systems, missile guidance electronics, communication equipment, drone technology, and governments don't negotiate on price when procuring defense materials. They pay what's necessary, and they don't announce their purchasing. They accumulate quietly through intermediaries off-market. Which brings us to the third pressure point. Pressure point 3. COMEX warehouse depletion entering critical zone. Remember those declining COMEX inventories mentioned earlier? Let's put specific numbers to it. In June 2023, COMEX registered silver inventory stood at 287 million ounces. By February 2025, it had dropped to 114 million ounces, a 60% decline in less than 2 years. Where did 173 million ounces go? It didn't vanish, it got delivered, taken off the exchange, moved into private hands. Now, 114 million ounces sounds like a lot of silver, until you compare it to open interest. Open interest, the number of outstanding futures contracts, currently represents claims on approximately 890 million ounces. That's nearly 8 times more paper claims than registered physical inventory. Under normal circumstances, this ratio doesn't matter, because only 2% of contracts typically go to delivery. But what if that percentage changes? What if 5% demand delivery? What if 10% do? The mathematics become impossible very quickly. And here's the detail that should concern business leaders holding silver derivatives. In March 2025, a major futures contract rollover occurs. Thousands of February contracts held by traders who haven't closed their positions must either be rolled forward to a later month or settled. Historically, most roll forward. But in a tight physical market, with premiums at record levels, with warehouse inventories declining, the incentive structure changes, taking delivery, even at the cost of transportation and storage, becomes more attractive than trusting the paper system. If even a small percentage of March contract holders decide to stand for delivery, COMEX faces a problem it hasn't encountered since the 1980s. Pressure, point 4. Eastern accumulation. Accelerating. While Western investors largely ignore silver, focusing on stocks and bonds and cryptocurrencies, Eastern buyers are accumulating, quietly, systematically. China's official silver imports in 2024, 287 million ounces. But trade analysts who track shipping data, who monitor refinery outputs and consumption patterns, believe actual imports were closer to 340 million ounces. The difference? Unofficial channels, gray market flows, strategic stockpiling that doesn't appear in government statistics. India consumed approximately 290 million ounces in 2024. Not for investment, for cultural consumption. Jewelry, religious items, wedding gifts, demand that doesn't fluctuate with price because it's embedded in tradition. And then there's the Middle East, sovereign wealth funds, royal families, entities with multi-trillion-dollar portfolios, looking at a global financial system showing structural stress and quietly shifting small percentages into physical commodities. Just 1% of Middle Eastern sovereign wealth, approximately $400 billion, converted to silver at current prices, would require 5.4 billion ounces. Total global annual mine production, approximately 840 million ounces. The mathematics don't work, which is exactly why premiums in Dubai hit $127 per ounce. Because when buyers appear with serious capital wanting physical metal in size, the market reveals its true depth, or lack of it. 4 pressure points: supply disruption from China and Mexico, industrial demand acceleration that can't be delayed, COMEX inventory depletion approaching critical levels, Eastern accumulation absorbing available supply. Each one, individually, would create market stress, all 4 simultaneously, create conditions for something much larger. The bridge isn't just swaying anymore. The cables are starting to fray. There's a difference between prediction and preparation. Prediction is what analysts do on financial television. Confident declarations about what will happen next, delivered with certainty that evaporates the moment markets move differently. Preparation is what serious business leaders do when they recognize structural instability, regardless of whether they can predict exact timing. And the silver market in February 2025 isn't asking business leaders to predict the future. It's asking them to recognize what's already visible and position accordingly. Because here's what experience teaches about markets under structural stress. They don't move gradually. They don't provide polite warnings. They remain stable, then break violently. And by the time the break becomes obvious to everyone, the opportunity to prepare has already passed. So let's discuss what preparation actually looks like. Not through speculation, through scenario planning. The 4 scenarios business leaders should be modeling. Scenario planning isn't about guessing which future will occur. It's about understanding the range of possible outcomes and identifying which decisions make sense across multiple scenarios. Scenario 1, orderly adjustment. In this outcome, current pressures resolve through normal market mechanisms. COMEX inventories stabilize around current levels. Chinese export restrictions ease slightly as diplomatic negotiations progress. Industrial buyers adjust to higher prices, but supply chains remain functional. Physical premiums narrow from $54 to perhaps $15 or $20 per ounce. Paper and physical markets remain connected, if strained. Silver prices rise to $95, $110 per ounce over 12 to 18 months. Volatility, but no systemic disruption. This is the best case. The outcome where existing market architecture survives. Modified but intact. What should business leaders do if this scenario unfolds? Those with silver-dependent supply chains face gradually rising input costs, manageable through normal procurement strategies. Those holding silver as a monetary hedge see appreciation, but nothing dramatic. Life continues, just more expensive. Scenario 2, sustained divergence. This is where paper and physical markets effectively separate. COMEX continues trading. Prices remain around $75 or $85 per ounce. But physical silver, actual metal you can hold, trades at persistent premiums of $40 or $70 per ounce. 2 different markets, 2 different prices. Industrial buyers scramble for physical supply, paying premiums. Financial investors hold paper contracts, watching their silver exposure fail to track actual silver scarcity. Arbitrage doesn't close the gap, because moving physical metal from west to east faces logistical barriers, regulatory friction, transportation constraints. This scenario has precedent. It happened in palladium markets in the late 1990s. It happened in nickel during the 2022 squeeze. Markets that should be unified fracture. What does this mean for business leaders? It means the silver price becomes meaningless without specifying which market. Companies needing physical metal for manufacturing face dramatically different economics than investors holding ETFs. Supply chain managers can't simply look at COMEX quotes anymore. They need relationships with physical dealers, forward contracts with refineries, alternatives to just-in-time inventory management. Scenario 3, exchange settlement failures. This is where the mathematics of phantom supply meet physical reality. A large contract holder, or multiple holders simultaneously, stand for delivery at COMEX. The exchange doesn't have sufficient registered inventory to settle. They declare force majeure, cash settlement instead of physical delivery. At prices, the exchange determines. Lawsuits follow, congressional hearings, regulatory investigations. But by the time legal processes conclude, the damage is done. Trust in paper silver markets evaporates. Physical premiums explode to 100 plus per ounce. Investors holding silver derivatives discover their contracts can be settled in cash at prices that don't reflect physical scarcity. This isn't theoretical. The London Metal Exchange did exactly this with nickel in March 2022. Canceled trades, forced cash settlements, changed rules mid-crisis, because the alternative, allowing physical delivery to proceed, would have bankrupted major banks. What should business leaders understand about this scenario? Counterparty risk becomes primary risk. It doesn't matter what a contract says if the exchange can change the rules. Physical possession, actual metal and secured storage, becomes the only reliable exposure. Paper claims, even from reputable institutions, carry settlement risk that most investors don't understand until it materializes. Scenario 4, systemic price discovery breakdown. The extreme scenario, multiple exchanges face settlement problems simultaneously. Governments intervene, imposing trading halts, price controls, export restrictions. The silver market fractures into regional markets with dramatically different prices. International arbitrage becomes impossible due to capital controls and commodity export bans. Shanghai trades at one price, London at another, New York at a third. Physical metal available only through gray markets at premiums of 200, 300%. Industrial supply chains face genuine shortages, manufacturing delays, production shutdowns for silver-dependent components. This is the crisis scenario. The outcome, where the existing market architecture doesn't just strain, it fails completely. Probability? Lower than scenarios 2 or 3. But impact? Catastrophic for unprepared businesses. Exposure. Assessment questions. Business leaders should be asking now. Understanding scenarios means nothing without assessing actual exposure. Here are the questions that separate prepared organizations from vulnerable ones. First question. How much silver does your supply chain actually consume? Not just direct purchases. Components from suppliers, electronics, solar integration, specialized manufacturing inputs. Many business leaders don't know their indirect silver exposure. They should. Second question. What's your counterparty risk in precious metals holdings? If you hold silver ETFs, have you read the prospectus sections on settlement procedures during market stress? If you hold allocated silver, have you verified the storage independently? If you hold silver futures, do you understand the conditions under which exchanges can impose cash settlement? Third question. How quickly can you adjust procurement strategies if physical premiums continue rising? Do you have relationships with multiple suppliers? Can you forward contract for physical delivery? Can you increase inventory buffers without straining working capital? Fourth question. What's your currency exposure in a scenario where silver prices spike? Silver historically moves inversely to dollar strength. If silver surges, it often coincides with dollar weakness, which affects import costs, debt servicing, international revenues. These aren't questions with simple answers, but they're questions that need to be asked now, and while options still exist. What to watch next? Early warning indicators. Strategic intelligence isn't about knowing everything, it's about knowing what to watch. Here are the specific indicators business leaders should monitor. COMEX warehouse reports, published weekly. Watch registered inventory levels. If they drop below 100 million ounces, the system enters genuinely critical territory. Watch delivery notices during the March contract expiration. Historically, March delivery month sees 15,000, 25,000 contracts standing for delivery. If that number exceeds 40,000, it signals changing behavior. Watch physical premiums in Singapore and Dubai markets. These are canaries in the coal mine. When Eastern physical markets show widening premiums, it means supply tightness is real, not speculative. Watch Chinese export data, specifically refined silver volumes. If monthly exports drop below 15 million ounces, it confirms that Administrative Measure 47 is having material impact. Watch for unusual activity in options markets. Large purchases of out-of-the-money call options, bets on extreme price moves, often precede volatility. Professional traders positioned before the crowd recognizes what's happening. The final framework. Intelligence versus investment advice. This analysis is not investment advice. It's strategic economic intelligence. The difference matters. Investment advice tells you what to buy, what to sell, what to hold. Strategic intelligence gives you the framework to make informed decisions based on your specific situation. Because there is no universal answer. A solar panel manufacturer faces different risks than a financial investor. A business with currency hedging faces different exposure than a supply chain manager. What remains constant across all situations is this fundamental reality. The silver market is showing stress indicators across multiple vectors simultaneously. Supply constraints, demand acceleration, inventory depletion, Eastern accumulation. And Most importantly, a growing divergence between paper prices and physical availability. When paper promises exceed physical capacity by ratios of 100 to 1 or higher, when regulatory interventions freeze major trading positions, when premiums in physical markets reach $54 per ounce above futures prices, these aren't random fluctuations. These are structural signals. And the business leaders who recognize structural signals before they become mainstream news are the ones who don't get caught unprepared when markets shift. The question isn't whether the silver market faces stress. The evidence answers that clearly. The question is whether your business, your supply chain, your holdings, your strategy is prepared for what happens when paper promises meet physical reality. Because that meeting is no longer theoretical. It's already begun. And what happens next will be determined by who prepared and who assumed stability would continue. The final warning has been given. What comes next is up to those paying attention.